Good evening, everyone. Welcome to Apple Markets. My name is Chris, and today something very special going on because Nenet Kirkes, also known as Tarantula, is sitting right next to me for the first time. We're actually having a webinar, not only from together, but actually in the same room. Hi, Nenet.
Hi, Chris.
I hope there's no echo.
Hi, Chris. Yeah, I'm here with Chris, and we will do this webinar together from the same room. So, hi everyone. We will make this special. We have some techniques that we will show you today. So, stay tuned.
Yeah, we're very excited about that. Normally, of course, Nenet talking from Belgrade, and I'm from Prague, and Nenet is visiting Prague, so that's great. We're going to be talking about advanced methods for trading Forex markets with moving averages. So stay tuned for that. First of all, though, be aware that this webinar is shown to a global audience, but may not be suitable for everyone. Take a look at avromarketsglobal.com, select your country of residence, and contact an appropriate entity to find out more about that. Also, please be aware that trading for exchange and global financial markets is considered high risk and may not be suitable for everyone. Please seek the advice of an independent financial advisor for more information on that. This webinar is not advice and is for informational and educational purposes only. Plus, by continuing watching this webinar, you agree with this disclaimer and you're aware of the risk involved when trading. All right, so very excited about this topic. I think one of my favorite topics, in fact. Maybe you're an enthusiast just like me, then I would say grab your seatbelt because I think you'll have an interesting ride. If you're not that fan of moving averages, then ask any questions you like through the chat, of course, if you get lost by any chance. And hopefully it's not too detailed for you, because after that, then we'll take a look at some strategies, so that could be still something maybe more interesting for you. All right, some basics. First of all, we're going to take a look at not the very, very basics. That's not the meaning of the webinar, but still wanted to tell you that studies have shown that simple moving averages and exponential moving averages are very profitable and doing a great job. EMAs tend to be a bit better on average, the profitability at least, according to those studies, but I guess that can always maybe differ from study to study. What that study showed me was 20 to 40 EMAs are the best ones, but the main point is that all of these moving averages are very profitable. So that's a good starter, of course. You can use various ways of moving averages. One could use one EMA, you could use 2 sets of EMAs, or even 3 sets of EMAs, increasing the complexity, of course, as you go along. If you like to read candlesticks and price action, you can just simply add one EMA as a reference point, and that's it, and that's fine. If you're more of a EMA fan or moving average fan, you might use 3, like I do, as indicated in the left lower corner. That's an example of how you could do it. You have different speeds of moving averages, ranging from very quick to very long. This is just a rough bracket on the right side between quick, short, medium, long, and very long. It's disputable, it's debatable where that border is, but I put the quick between 3 and 13, short between 14 and 34, medium between 35 and 89, long between 90 and 199, and very long is 200 and higher. So that gives you an idea how I think about it. I myself use one quick, one short, and one long. So that's the combination I use: quick, short, and long. But I think there are a lot of combinations that work very well. All right, so what is the difference between them? I'm assuming that you're talking about SMA and EMAs. SMA is simple moving averages, and exponential moving averages, EMA. And the difference is basically that EMA, there's more the weight, the importance of the recent candles has more value in the calculations. Simple means that all candles are counted equally towards the average. All right. Some other things, you can use multiple time frames to get an idea about the location of those moving averages. For instance, the 21 EMA on the 4-hour chart will be roughly around the 144 EMA on an hourly chart. So that gives you an idea. If you have a 200 EMA on an hourly chart, that could be roughly equal to the 50 EMA on a 4-hour chart. So that gives you also a bit of idea how you can look on one time frame but still get clues from different time frames. You can use moving averages, as you probably know, for support and resistance, as indicated here in the screenshot. You can see how price is using that as support, riding along these three EMAs. You can use it as momentum and correction. When an 8 EMA is bullishly angled and strongly angled, that shows there's momentum. You can use it for trend, reversals, ranges, pullbacks, retracements, entries and breaks, and filters. And today we're going to talk about all of these. So here we go. First of all, though, sorry, my EMA numbers, to be specific, I use the 8 EMA close. That's to show momentum. I use 21 EMA close, high, low for support and resistance and showing the trend. That's this orange band that you see here. That band is created by the fact that I use close, high, and low. And the band shows a zone of moving averages rather than one point. I like to use a zone because it shows more accurately, I think, where that zone can be. Whereas if you use one single point, basically, you, I think, automatically attach maybe a bit too much importance to one point on the chart. I like using zones myself. There's nothing wrong with using one EMA, only the 21 EMA close, and just using that as is. I like the extra visual reference myself. The 144, 169 I use as a long-term trend here, and that's the purple because it's pointing down. That's why it's bearish. So you can see long-term trend down, medium trend is down, that's the orange, and the 8 EMA you don't even see here because that is showing the momentum. All right, so that's basically my EMAs. Let's move on, talk a bit about the 21 EMA first of all. I use the 21 EMA, as I said, for trend, for direction. So obviously, when price is below it like this or above it, it shows up or downtrend. That's a very simple rule of using the 21 EMA. Where is price in relationship to that 21 EMA, and that is the trend, right? If it's below, it's an uptrend, downtrend. If it's above, it's an uptrend. And if the price is in those EMAs, then there's no trend. There's a pullback or there's a reversal. There's indecision. Now the angle, you can see when price is falling here, the steeper the angle, the more momentum there is. Whereas, of course, when price is going like this, there's obviously more of a correction and sideways move here too. So the angle will also give us an idea about how strong the momentum is going as well. So those two things are important with looking at the 21 EMA. But I also use 21 EMA for support and resistance. So the 21 EMA is very important because there are multiple things I use for that. And the 34 works very well as well. I think the 30 or 40 could do just as well. The reason why I use 21 and 144 and 8 and sometimes 34 and why I would use 55 and 89 if I would go for those numbers is because they're fib numbers. I like Fibonacci sequence moving averages. That's just, I guess, a kind of a ritual for me. So that there's no specific reason why, but I like fibs, so I started using that. 21 EMA I use as supportive resistance too. So I not only use it as trend and momentum, but the band also acts as supportive resistance. But how do we know when the band will act as support and resistance or when it will not? And a rule of thumb I use is how many candles have moved away from the 21 EMA band. Look at this left example here. We see about 9 candles not touching the 21 EMA band. So when price goes back to that band, it's used as resistance. Then we get another move down here. Look at that. I think even more. Basically, we're looking at, I think, 15, 20 candles. So when price gets back, it uses it as resistance. The first time, only a bit though. The second time, a lot more. And this is something, of course, I want to make you aware of. These are rule of thumbs, and they work generally pretty well, but it's definitely not that they always work. It's definitely not so that each time price will accelerate from these bands. Sometimes you get a bit bigger correction. The markets are not as perfect as sometimes we would like to have them. Obviously, they have some movements that sometimes expand in corrections before we get the impulse we actually hope for. So this was a perfect example. This was a small example, just moved a bit before. It still made a bigger correction, and this worked very well, as you can see. All right. Now, which time frame? Basically, you can use this rule on all time frames, I would say, but I would not use the 21. I would not use um, a 21 EMA for a trend. Let's say maybe on a minute chart or a 5 minute chart. I mean, there's not really a trend on those time frames. We can talk about momentum. Yes, of course, there's momentum, a lot of momentum on those time frames. Markets are moving quickly, so definitely momentum. And you can use moving averages to measure momentum on those time frames, but I don't think we can talk really about a trend that much. I would rather look at higher time frames for that. Using moving averages for support and resistance, I think generally you can use all time frames as well. But you want to be careful maybe on a 1 or 5 minute chart to really expect a lot of bounce at those bands. Price can break through those bands, I think, quicker. They're not as robust as they would be on a 4 hour chart. All right, so now these are cases where we have a lot of candles below it. Here you can see price didn't really break above the 21 EMA, hardly broke above it at all. There were still, most of the candles were still touching it, so there's no momentum here, right? Here you can see that all these candles are touching the EMAs, or most of them, which means that there's no significant push away from the average, which means that price will use the 21 EMA actually to revert back to it. All right, that's when a range is taking place. So when basically price is right around those moving averages and touching it all the time and hitting it, then most likely actually if it kind of escapes it for a bit, it's going to go back to it. That's what I mean with gravitational pull. When it tries to move away, it gets slammed back to it. It tries to move away, it gets slammed back into it. And it doesn't really pick up space and just doesn't have any support or resistance value that much. All right, so that's a bit of a difference. When it's used as support or resistance, when does it have actually more of a gravitational pull? All right, now the 21 EMA, how do I use it in relationship with the 144? I like to use both because I can see what the trend is on a longer direction. When I only use the 21, that's fine. It's good for trend, but I like to see it in relationship with the 144 because then I see if there's even a stronger trend taking place. For instance, at the top here, I can see that a downtrend already was occurring from this moment. But the trend was even stronger when the 21 was below the 144, right here. And you can see that once this is happening, when they're aligned, when price is below the 21, when 21 is below the 144, basically we have price being aligned, and that's even a stronger trend than only having the 21. So by putting on the 144, we can see when things really line up, even more than just having the 21. That's why I like to have those two on the chart. Now the space between those, as you can see, the more space between the 144 and 21, right, the more trend we have, the more stronger the trend is. And when the space is small, or is decreasing, or there is no space at all, like here, then price is in a range. It's in the consolidation. And basically, you can see that as soon as price tries to pull away, it gets slammed back, slammed back, slammed back, slammed back, right? That's typical for a range, and it's oscillating. Price is basically oscillating around those moving averages. Normally, I use these moving averages. Well, I use them on 4 hour, 1 hour, 15 minutes, and daily. I use them on all time frames, really. But I mean, obviously, I don't look too often on a weekly or monthly chart, but I do occasionally. The value of these moving averages on those charts is less because things don't update that quickly. We have 1 bar, obviously, per week on a weekly chart. So, things are not going to develop that quickly. But you don't have to use them on all time frames. You could choose to say, I only use moving averages on 1 time frame. I only use them on the 4 hour, or I only use them on the 1 hour, or I use the trend moving average on the 4 hour, and I use a momentum moving average on a 15-minute chart, and have the 21 EMA on the 4 hour and an 8 EMA on a 15. You can play around with those things and see what you feel comfortable with. Alrighty. So that's that. Next thing, 8 EMA versus 21 EMA. The 8 EMA for me is momentum, right? So we might have a trend going on. We might have price aligned with the 144 and price, around the 21 EMA. But if the 8 EMA is not aligned, then the momentum is not going to be our way. So obviously, when we have these three things aligned, you got a swift, beautiful trend going on. And I'm not saying this is the only moment that I would trade it or the only moment that a trader can trade it, but this is the sweetest spot available because then everything is aligned. And if you look at many time frames and look at many currency pairs, you're going to find, a couple of these every week. All right. Sometimes it's worth trading reversals when prices are going back to the moving averages, maybe because there's nothing available where everything is aligned. I'll give you a few examples of those as well. We'll dive into reversals in just a second. First of all, the trending situations. So I use the 8 EMA as a measurement of momentum. Now, what I look for is basically here you can see price above the 21 EMA, candles not touching the 21 EMA. The 21 EMA is above the 144. Got everything aligned, right? 21 above 144, price above 21. And not only that, price is not touching the 21. 8 EMA is bullish. And the first time it becomes bearish, that's a pullback. All right? That's what I consider a pullback. And when it turns back bullish, right here, that could be seen as a continuation. Break, pullback, continuation. So those are potential entries right there when the 8 EMA switches and then turns again the second time. Those are good for entries in general, unless I have some reasons where there's some news events, there's some filters going on, some big strong support resistance around the corner, like a fib. That's of course reasons not to take any trade. So these three are examples. Now here, these three arrows, these three pink arrows right there. Then we have a fourth example right here, where price basically goes back to the 21 EMA, but the 8 EMA never turns up again, right? So this was not a setup. All right. Now, obviously, sometimes we do get a setup and it goes up and fails, and that's why we have to be careful of divergence, which we'll talk about in a second. All right. As long as there's no divergence, there's a decent chance that these pullbacks will see decent continuations. Another thing I would like to see is price back to the 21 EMA. Anytime price gets back to the 21 EMA like this, and the 8 EMA turns back up, those are, I think, good pullbacks for trending momentum continuations. Price back to 21 EMA, 8 EMA, two changes, and that's it already. Now, that's a small pullback, right? But sometimes price retraces deeper. Price goes back all the way to the 144 EMA, not only to the 21 EMA, not only to this 3 band here, but all the way to what I call the tunnel, all the way to the 144 and 169 EMA. That's a deeper retracement, and that happens sometimes, right? And what I therefore also look for sometimes is a continuation off of those moving averages. And the same technique can be used with the 8 EMA, basically. The only thing, we have an example right here where the 8 EMA turns. The only thing you got to be careful of is that price, rather quickly continues back into the direction of the trend. If it has any struggle, like here, with breaking the 21 EMA, then you got some trouble on your hand. All right? Price is retraced back to the 144. It's respecting that level. It might be bouncing a bit at that level, right? But there's no continuation. There's the bounce, but price just goes sideways. Now that can happen, and there is a way to get out of it. If, for instance, we don't see any push above the 21 EMA here, boom, could be time to get out, right? Either through a trail or just a market exit, all right? So anytime it fails to get out above that 21 EMA, and it doesn't break the candle high within 5 to 6 candles. And look at this, all of these moves up here are within 5 to 6 candles. If it fails to do that within that time frame, then often enough you're looking at weakness and failure. Sometimes not. Sometimes it just takes a bit more time before we get the move up, and there's always a chance to rejoin later on after exiting. All right, there's no shame in exiting and then rejoining the trade if it still goes our way. As long as we're not revenge trading, that's good. All right, so that's the 8 EMA versus 144 EMA. That's a deeper retracement. Basically, when I talk about pullback retracement, I use this. When price is going back to the 21 EMA, I talk about pullback. When price is going back to the 144 EMA, I talk about retracement. And when price goes beyond 144, and when the EMAs cross, it's a reversal. So this right here, where I have the blue circle, well, let me make that pink. Pink circle, those are pullbacks. Where I have the orange circle, that is a retracement. And where I have the yellow circle, yellow is probably not visible, so let me make that blue, that's where we have a reversal. All right, so now you can see the distinction of what's going on. All right, here we had orange clearly price stopping and bouncing. Same with pink. But with the blue, price breaking through, and then we get the reversal, and we get a crossover right here. All right. Now let's talk a bit about those reversals and those crossovers. All right. By the way, if you have any questions, by all means, let us know. We might have some time for Q&A at the end. So by all means, go ahead. Feel free to write anything you want. Reversals basically happen when the moving averages have a crossover. But don't get me wrong, they're not a good entry point. I don't trade crossovers. I just look at the charts, and if I see a crossover, I recognize it as a potential reversal when the 21 drops below or above the 144. Now, it might not be a total reversal, right? Here in these cases, we had these were retracements because price was ultimately just pulling back, retracing, and still continuing with the trend, right? But look at the difference right here when price really broke through the 144 EMA. Not only price broke through it, but the 21 EMA clearly went below it. You see that? So that is the first thing that, of course, is an important reversal. The second thing that you can look at, where are the fractals? Do you see the fractals here? Do you see the fractals here? Fractals, right? These fractals stay above the long-term moving average. Do you see that right there? You see those staying above the long-term moving average right there? Those pink boxes here, here, oh, here. Those fractals stay above it. The resistance fractals, I should say. All right, that's a clue that price is making a retracement. Here, the resistance fractals are right at them, and here, in fact, they're already below them. That is a very fundamental difference. When the resistance fractals start to switch their sides, and they're not anymore above, but below, that's the extra signal that really a reversal there's a good chance of reversal taking place. So, third thing for reversal is the presence of divergence. Lower than an hour, double divergence or even triple divergence is very important. On an hourly chart, a single is not bad, but a double is better. Whereas lower than an hourly chart, I think it's crucial that we have double or triple. On a 4-hour chart or higher, a single divergence is often enough, is very often enough, but not always. Look at the dollar CAD, it kept pushing lower where it definitely had divergence. Once divergence is present, double or triple or single, depending on the time frame, the target of that divergence is the 144 EMA. Don't get me wrong, sometimes after divergence, price could go a lot further than that. And it could be a reversal even after divergence, especially if there are multiple divergences on multiple time frames. But the minimum target is the 144 EMA. That's the rule of thumb. Once again, sometimes it will miss it by a bit. It can happen. But the rule of thumb states 144 is the target. Here, for instance, we had divergence between these bottoms. Boom, back to the 144. All right? That's the idea. Here, divergence between these bottoms, boom, back to the 144. That's the target. Once price has hit the 144 EMA, and hit the target, divergence in theory is in a way already not a factor anymore on that time frame. Now there could be a higher time frame that has divergence too, and that could still be lingering, right? So be careful of that. But the minimum target has been hit, so it's less of a factor, less of a thing to consider. Hi Ilya, good to see you. Last slide, you mean this one with the reversal? We can keep it on for you, no problem. Is that the one that you're looking for? So with divergence, when price got back to the 144, that's a spot where we can get a reversal, but we can also easily just have a retracement and a trend continuation. Remember that when price gets back to 144, it could also be a retracement. So it's at a crucial spot. It could be a retracement for a trend continuation, but it could also be a reversal. So it's kind of exciting time for the market because which one is it going to be? Both sides could be very interesting. It could turn out to be a range too, which becomes, of course, less interesting, and then the market could go just sideways for a while, and those 21 and 144 could be on top of each other. All right, so that's that. Now, as I said, single divergence on one time frame is interesting, but if you have multiple divergences on one time frame, it's stronger. If you have a single divergence on multiple time frames, wow, that's even stronger again. But if you have multiple divergences on multiple time frames, one ready example that I have that at the top of my head I'm just thinking about now were the yens 3 years ago, 4 years ago, and maybe in the meantime, when the euro yen was down at 95 and the dollar yen was down at 75, and there was multiple divergences on multiple time frames, and indeed we got this massive rally of 5,000 pips on the dollar yen and pound yen going all the way, I don't know how many, even more probably, right? Tremendous amount. So those were multiple divergences on multiple time frames. Those don't happen, of course, every day of the market, unfortunately. Those are very, very, interesting, but rare, of course. The yens were a perfect example of those back in the day. Alrighty, so the more divergence, obviously, the more strength that is. We talked about in the trading room, I think it was yesterday, about Euro New Zealand going back. This is the hourly chart. Price was right here. This pink circle with the pink arrow, I remember very clearly where price was. And I was saying, look, price is dipping below the 21 EMA for the first time. It's not going to be able to break below that 21 EMA in one shot. It's going to bounce off that 21 EMA and then most likely break down back to the 144 and fail to continue higher because we have divergence. The target is the 144. This is only the first run down. We should see a correction because we're going to get a bounce at the 21 EMA and then a third move down. A 1, 2, 3 or an ABC, whatever you call it, we're going to see that motion. All right, so that's what we got. We had indeed a bounce right here. We got a couple of candles up. We couldn't break this top. If you put a fib from here to here, we probably had a 61.8 bounce or a 78.6 fib. Price couldn't break that candle for a few hours and then boom, fell right down to 144. Closed the gap, boom, reversal trade accomplished. Those are reversal trades that are possible. Not everything has to be aligned. Kiwi dollar to the upside was a great example. That even moved more. That was also a trade we said, look for upside because it's at support and it's showing divergence and it has space to the 144. And not only did it move 86 pips to the 144, but it went above the 144, another 170. All right. Two examples of reversal trades. So a bit about theory, very shortly, gravity and force. Why is this occurring? Because basically price action is force and the moving average is gravity. And it's always this battle between them. Force versus gravity. If force is heavier, is stronger, then price is going to be able to move away from the average. However, if gravity is heavier, price is going to get back to the moving average. All right. So here, the momentum is heavy and it's able to move away. Eventually, though, on lower time frames, we're going to have divergence and price is going to make a bit of retracement. But because on this time frame there's no retracement yet, it's just a pullback for more downside until we have divergence on this time frame, which we'll see a bigger retracement up to the 144. So understanding when force and gravity is winning is definitely very important also to look at divergence, because if there is divergence, that means there's a better chance for gravity to win. If there's no divergence, that means there's a better chance for force to win. If the moving averages are on top of each other and they're aligned, then gravity is going to win because there is no force visible. If the price is on moving averages and the moving averages are on top of each other, then basically there's just a consolidation, there's no momentum, and gravity is stronger. So last but not least, it's a bit like the psychology of path of least resistance. If you look at a group psychology of humans, right, it's the same what happens with the moving averages. Let's say we have a group of people, 10 people in this circle, and they have an assignment to figure out where this group will stand 4 hours from now. No one knows, right? Maybe we can say that the group 3-4 hours from now was here. The green circle was where the group was 4 hours from now. So we have a bit of motion going this way, right? So one guy in the group is clever and thinks, wait, I see that motion going that way. So I think that the group 4 hours from now will also be a bit that way. So he steps a bit outside of that circle, slowly but carefully, checking how the response will be of the others. The others say, hey, that guy is moving that way. The second guy sees that guy move that way, thinks, hey, I'll follow him, right? And then the third says, hey, that makes sense, I'll follow him. And then the fourth guy goes, and then the fifth lady goes, right? And then the first guy thinks, hey, I was right. Well, I might make another step there. So this is kind of the momentum, and this will continue to a point and continue to go this way as the average goes along until at one point we get divergence and the person thinks, wait, I've moved way too far here. I think that the average will probably be more here. So we'll get a circle eventually that will be around here and not all the way here because people will realize that they're going too far. All right, so that's my amateuristic kind of explanation of how you can see psychology in it. The path of least resistance basically says that price will follow the easiest route of movement. So that's basically what happens when I'm looking at moving averages. I see price moving away from the 21 EMA, and I know when we have divergence on the lower time frame that price will get back to that 21 EMA eventually. But if enough candles, 5 candles or more, have moved away from that 21 EMA, I know that that 21 EMA will indeed act as support or resistance. So once it gets back to it, price will use that as a bouncing spot for trend continuation. Eventually, price will make divergence, and then price will not only get back to the 21 EMA, but back to the 144 EMA. And that is a reset point after which we'll get a trend continuation again or a reversal. And that depends. If this is an hourly chart, it depends on the 4-hour chart. If this is a 4-hour chart, that will depend on the daily chart. Whether we get a reversal trend continuation really depends on the structure and context. Because, for instance, if the 4-hour chart, we see price like this falling in a downtrend nicely, right? And we see a correction, price going back to the 144 EMA. All right, will this be a moment for downtrend continuation or a moment for a bigger reversal? It really depends on the daily chart. If the daily chart has divergence, then it's very, very likely that this will happen, the bigger reversal. All right, and not the trend continuation. If there is no divergence, well, then probably the red arrow will occur. And indeed, we'll get a trend continuation. All right, so this is how I use the moving averages to understand what is the most likely path for price. What will the path of least resistance most likely be based on divergence and the reaction of price, the difference between the moving averages as they interact with each other, and price and fractals. And that's how I lay out a path of price, and I look at what parts are the most interesting for me to trade. That's what I often talk about in the webinars on Tuesday and Wednesday. So that was my part. I talked way too long. Now Nenad is going to give his view. Oh, the MA settings. Yeah, sure. I use 8 EMA close. And I'm sorry if this was maybe technical for some of you or going into many details, but I'm just very, very excited about moving averages. So I wanted to share you all of my good stuff that I think is the most interesting. And this is how I use it. So I use the 8 EMA close, 21 EMA close high low, 144 and 169 EMA close. But I think that if a trader would use 13 and 34 or 55 here and would use, I don't know, 200, it would be just as good. Or here 13 and here 34 and maybe even 89, if you want to squeeze it a bit more. I don't know. Those are all possibilities. Two. I like this personally, but those are definitely possible as well. Or even a 5 here and 21 and 89. There are a ton of possibilities like that. Alrighty. So I think, Cesar, you should have those settings. I can write it down as well, by the way. That might be a bit easier. Let me pass it over to Nenet. How's it going, Nenet? Is grabbing his microphone, I think.
Yeah, everything is fine. So let's first do a quick sound check. So I think you can hear me. Everything is fine, I guess. Excellent. So Chris, you can watch the questions because I'm speaking directly from my laptop. And hi again, guys. I'm here at Chris' apartment, and we are doing a live presentation. We are together at the same time and space now, and everything is working perfectly. So it's been very cozy here, and well, to be honest, the material that Chris shared is excellent. And today, as you can see, I will be showing you some different EMA techniques that have been working great on some systems and on some methods. So maybe you are keen to actually try to test it. A part of this will be also contained in our price action trading school. So for this opportunity, I will use 4 different EMA techniques that you can also use, try to test it, especially if you want to possibly develop your own trading system. So let's start with the first combination. First of all, we can see the indicators combination that I'll be using here. So it's 5 simple moving average that is represented as a red line, and the second one is 200 exponential moving average. We have 5 SMA and 200 EMA on the same chart. This technique is actually using EMA crosses to pinpoint for a possible entry. You probably know that, same as Chris, I'm not a big fan of EMA crosses as entry methods, but 5 SMA, 200 EMA, I have tested it I've been testing it for last 1.5 months, and it can produce good results if it is used with additional indicators that will serve as a filter. Of course, this is not just a system by itself, but this can be a good base to start on working how to filter out good entries. So here you can see my 1-hour chart, and simply when we have EMA cross, that means that we possibly have an entry. Of course, this can be also drilled down to 15-minute and 5-minute chart, but the thing is, these EMA crosses also produce good results just by themselves. But of course, because in the times when there is no big trend, it can be a bit whipsaw, so we need to apply additional filters. But as soon as we have the start of a good trend, moves can be real good just by applying 5-200 cross. Here you can also see on a 15-minute time frame, $Swissie, you see whenever there is EMA cross, it produces some good number of pips. Mind you, however, that M15 is mostly used for intraday entries, So even if it shows like 30, 40 pips, it's still good concerning it's like intraday. But here, at this example, you can see when we have an EMA spiral that is not so good to our account, so we should avoid it in ranging markets. How we avoid it is actually by placing additional filters. Those additional filters can be CCI, can be MACD, can be awesome oscillator, can be Bollinger Bands. So it's all subjective to a living test, because we don't want to go through testing now of various systems. But I just want to show you how 5 SMA 200 EMA cross can be perfect. Perfect, of course, when we apply additional filters and when we have a strong trend. For example, look at this. Here there was a great EMA cross, there was not a cross in opposite direction, and the price soon fell for huge amount of pips. Look at this example. So it's basically, it can be huge when there is a strong trend. Look, huge. Even here we have an additional cross. Okay, when EMA crosses up, then crosses below, we have additional cross. And here, look at this. So when there is a strong trend, another, you see, another entry here. So when there is a strong trend, this can be very, very powerful. Okay, here we have a trend change. That it also, there was also a strong trend here. You can see a trend change. See, and this trend change can also be filtered out with additional indicators. And this 5 SMA 200 EMA cross, as you can see, even by itself, it precedes strong trends, and it can be very, very strong even in trailing the stop once you're in profit. You can see the dollar Swissy here, but of course, because this is price action, actually it works on most major pairs. I dare to say on every single major pair, and of course with minor pairs. See here, so if this is uptrend, we just need additional indicator to actually filter out this cross. Although this cross was good, it produces some pips, but we don't want to go versus trend. So whenever you apply for an EMA cross and you want to take entries with EMA crosses, be sure that those crosses are in trend direction. So for additional filters, we need to use probably oscillators. At this point, okay, 5 to 200 EMA cross can be very, very good as a basis for your future. Maybe if you like to trade with EMAs, this can be a great way to actually start by EMA cross. So 200, 5 SMA 200 EMA cross. The second one that I want to show you is also very, very good, and I placed additional indicator because I want to see how it goes with Bollinger Bands, and actually it's quite well. So we have Bollinger Band indicator, okay, on 100 period here. So Bollinger Band on 100 period, and actually this indicator is called bands because when I put this to none, the first line is set to none. When I do this, the Bollinger Band indicator will show no middle line. So I always want to see a Bollinger Band without a middle line because I don't need it. So if you want to have a band indicator, you can Google for it. It's free, but if you cannot find it, of course, you can send an email to me. I will send it back. So you just place none at the first point here, and your Bollinger Band will have no middle line. And at input tab, you just enter 100, so your Bollinger Band will have 100 period deviation. So not deviation, 100 period moving average. So actually, what I like to see is the cross inside Bollinger Bands. So these two moving averages are 13 exponential, and the second one is 5. So actually, it's 513 EMA cross. That is also well known in Forex world. But how to filter out? Actually, this is how you can filter out it. So once you see this is congestion area here because there was no trend. But again, we can apply a trend filter. So let's say that we expect an uptrend. First, we need to see price breaking below the lower part of Bollinger Band as here. And then we want to see 513 EMA cross inside it. And here you can see the cross inside and a huge movement to the upside. Of course, the time frame that you can do this from is, I think that it can also be done from a 5-minute time frame, because 100 period Bollinger Band is also very, very, very big. So you can find it here, another cross to the downside, cross to the upside, cross, it goes up, you can see it here. And look, even when it crossed up the upper Bollinger Band, and we see an EMA cross inside it, it gave us a retracement. See? We could even take a short trade here at the 513 cross. That would have been good for 35 pips maximum. Not bad, right? So this can also serve as a base for a potential method, because if you watch Bollinger Bands, they're very, very good in spotting trend and congestion. See here, this is congestion, so we don't have any trend here. See how Bollinger Bands are aligned. And as soon as trend is formed, we will see a divergence. Look at the divergence here. Okay, look at this. So once we see the cross like this, we can see moving average cross inside it, and the price will usually go the opposite way. Trend entries are like this. We see a cross. First we see a price below moving average, then we see a cross of moving average inside Bollinger Band, and even here, see, it goes strongly to the upside. So here it could be a first entry, here it could be a second entry. Even though the first entry had a bit of drawdown, it would have been still possible to make some pips. See here, 50 potential pips, and here even on this cross, even more. So this can also serve as a base for some, maybe for exploring of additional methods or additional systems. And actually 513 is proved to work in Forex market. So by placing Bollinger Bands, we can filter out trades, and we just need additional filter for a trend that we can apply, and this can be also a base for a good system. So 513, EMA cross, and Bollinger Band outside and inside. So just test it. Another method that I also love to share with you is actually multiple time frame, and pay attention to this now. We need to place indicators as this. The first moving average is 10, exponential moving average. Visualization here is on M15 and 4 hours. So guys, please pay attention to this. This is important now. Okay? This is also advanced, and pay attention. So 15 and 4 hour period actually have 10 EMA. Okay, so 10 EMA, and I colored it as a red. Next one is 100 exponential moving average applied only to 4 hour time frame. Okay. Next one is 200 exponential moving average applied to 4 hour time frame. And the last one is 40 exponential moving average applied to 15-minute time frame. So what we want to see is actually multiple time frame analysis. First, we go to 4 hour time frame, and we need to spot the cross in trend direction. So actually what we want to see is if 200 EMA is above 100 EMA, we say the trend is to the downside. So we want to see 10 EMA cross either from the upside of 100 or 200 EMA. So this could have been our potential signal for entry. Here you see the price went above 200 and 100, and 10 EMA actually broke through this 200.
here we will place a line. Now, if we go with only 4-hour time frame, it would have been probably, well, we would have been probably late in our entry. That is why trading 4-hour time frame is actually better when we zoom it in a lower time frame. So for 4-hour time frame, we will use 15-minute entry technique. So this is our cross, okay? This is our cross. Now, if we go to 15-minute time frame, we actually want to spot 1040 EMA cross. So I will go to object list to show me actually, okay, but it doesn't show up. Okay, I will try to find it manually here. Okay, so let's find the cross. That is actually our entry. So first we spot 10, either 200 or 100 EMA cross in the trend direction, and afterwards we can actually go for 1040 EMA cross. Now I'm not sure why it doesn't show up. I will try to watch it again. Objects list, it should show on my chart here. Now it showed up. Okay, I lost it again. Let me try to do this again. Show, it doesn't show up. Okay, I will use another probably more close example. Okay, let's find another pair that had a recent cross. Okay, here we had, yes, here we had a cross of, see here, there was a cross of EMA just preceding this uptrend. We had a cross in bearish direction. So 4-hour cross, here you see EMA crossing. Now we will zoom on to 15-minute time frame, and I guess now it should allow me to see, actually this second, okay, great, here. So here, see, the cross happened here. So once we see the cross of 1040, we can trade it. So let's say that we have spotted a cross somewhere in this region. As long as the price, as the moving averages are still crossed to the downside, we can take the entry. So assuming that we spotted 1040 cross here, we could have entered here, and look, although the trend was changed, potential pip pool for this kind of entry was 158 pips. Okay, so let's use one more example. Okay, we need definitely to find other pair that possibly made a recent cross, because that way I will be able to locate 15-minute cross much better. For example, we can use, I'm sure at pound dollar, but across also at the end was fine, I think. Okay, you see, this is not an entry because 200 EMA is above 100 EMA, so we don't take this entry, although it was good because the price went up. But we want to take it as a trend. Okay, so we want to take this. Let me see if this will allow me to show on my chart. Okay, so this is a cross. Okay, this is more valid cross because this was the first cross. Okay, so this was the first cross here. Maybe a candle before this. Yeah, this was the cross. So let's zoom on to 15 minute and let's try to find it out here on 15 minute. Okay, show. Okay, you see it doesn't show up. I don't know why. Sometimes MT4, my laptop is bugged, I don't know. But it doesn't matter. Okay, I will try to find it again. Okay, 15-minute time frame. And if we don't find it, we will use another example. I just want to be sure that you're okay with this. Okay, here is the cross. Okay, so you see, here there was a 15-minute cross. Okay, it's 4-hour candle, so it could have kept, right? So this could be your entry here, or if you're late in entry, as long as the cross is still containing the price below it, okay, you can go with additional entry. So the best is to trade 4-hour cross at the same time as 1040 crosses on 15-minute time frame. So this would have been an ideal entry, but this entry would have been ideal too. Look at this, guys. Okay, this is now, of course, showing after the fact. But the thing is, this can also be a good multiple time frame basis for a system. 4-hour trend, okay, you watch 4-hour trend and actually you drill down to 15-minute time frame to cherry pick your entry. Okay, so if this is clear, great, then we can move on. If anything is not clear, guys, of course you are free to ask questions. Now I will look at this to see if there is actually any questions here, but I think that everything is fine. So guys, okay, we don't see any questions, so I can minimize this tab here. So this is clear. So this could be a great basis for a potential system. And even though this is pretty much very clear and concise, I'm thinking that this can also be a system by itself. But it needs to be tested, as from this point, this is looking pretty much fine. Pretty much fine. So 4 hours for trends and 15 minutes for entries. And final EMA show, I call it EMA show because this is really EMA show, because it has a lot to do with very advanced EMA crosses, because these are not just simple random crosses. As you can see, this can work. We have 2 EMAs here, okay, and the first EMA here is A8 exponential applied to close. The second, and yes, this is also multiple time frame. So the visualization for this can be all time frames. It doesn't matter, 834. But because we will be using it on 1 hour, I will put here, I will check 1 hour and 5-minute time frame. Second one is 34 exponential applied to close, and we should see it only on 1 hour time frame. So what we do is, actually I explained this. This is not my strategy. The original name for this strategy was finger trap strategy, and I think I have already showed it up like 3 years ago in an article. So I forgot the name of a respected author, and you can just Google for finger trap and you will find this strategy. So I'm saying again, I'm not the author of this strategy, but it's interesting. I need to say this is interesting. So you watch 1 hour time frame, and if you spot it, actually blue is above red, we say it's bullish trend on 1 hour, right? So it's a bullish trend. Now we want actually to trade this bullish trend. This strategy, from my personal testing experience, works best in trending market. That is normal, because in trending market you will see huge price movements. So when you see a huge trend like this, you just go to 5-minute time frame, and actually you don't trade any EMA cross, you trade the price cross. So what you want to see ideally is, as long as the price is, as long as moving average are aligned, so blue above red, we have an uptrend. And we want to see price below EMA and close above EMA. That way we are ensuring basically a potentially good entry for price versus EMA cross. See here, this could be one entry, and obviously this would be even better. So what I want to, what sort of filter I want to apply to is actually, I want also, if this is uptrend, I want to see this low period EMA, 8 EMA trending upward and then price cross. So I want to see it like this. It goes up, you see, it goes below, then it goes up. So this is my entry. It goes below, it goes up. Because EMAs are still inclined to go to the upside. If you see this example here, okay, this could also be a good entry here. You see, but the price is congested in this short range. So it's not ideal entry. Okay, it's not ideal entry. The ideal entry is when also this, look at this, EMA is going up, now it goes up again. price goes and it goes up again. Price goes down, but look at this EMA. It's really strong to the upside, and it goes more, even more to the upside. This is not ideal. See this? It goes down. So this entry here, I would avoid it, because EMA is going down, down, down. So these entries I would avoid. Next entry would be probably here, this one. And it would be good. Okay, this one also. But you see, this is a good, potentially good strategy. But it needs, as I say, more logic inside of it. And the starting point is you want actually to see EMA going to the upside, but the price goes below EMA and then crosses above EMA in uptrend. It's vice versa for short trends. Short trends, you want to see like this, 1 hour, it should show red above blue, okay, like this, red above blue, and then you zoom into 5 minutes and find EMA that is going to the downside and the price crosses up and then below. So actually these are 4 different techniques. You see, these are completely different techniques. You can try to use whichever you find useful, and I think that you can make good success if you want to be a creator of a system. This can be a great starting point. This kind of methods, and my favorite kind of method, we will do that in price action trading school course, but for this webinar, I think this could be more than enough for a basis point for a potential system. Now we are already over the time, so guys, if you have any questions, feel free to ask us. If there are no questions, then we can call it a day. And actually, stop loss pair. Well, Ilya, stop loss. Okay, here. Actually, sorry, maybe indices. Yes, probably. Well, I think it can work on indices. Ahmed is asking, yeah. I think it can work on indices. I haven't tried it, to be honest, but because indices are very fast, and indices are much faster than Forex price action, you might try it also in indices. For example, if DAX is making 100 pips, euro dollar will probably make 20 pips. So it's a lot faster than Forex market, but also it's more dangerous. So you need to test it. For stop losses, for this particular theory, okay, let's say that I would go with, if we are in uptrend, I would go with last swing to the low side, but on 1 hour time frame. So if I'm able to make 5-minute entry here, I would probably place my stop loss below the last most obvious swing to the downside. I think that your usual stop would go in between 20 and 35 pip, because usually on 1 hour time frame that is the average stop loss size, in between 25 and 35 pip stop. So you can try to do it. Can you repeat first strategy, EMA settings? Yes. The first strategy, EMA settings. No, there is SMA and EMA. The first SMA is 5 SMA here. So you see it's 5 simple moving average applied to close, and the second one is 200 exponential applied to close. So actually you can use these 2 settings. So 5 SMA, 200 EMA. Okay, so that's it, I think. This webinar is being recorded, so it will be uploaded, I guess, tomorrow. So guys, thank you for listening. Here Chris and I will enjoy Prague, and we will enjoy our time together now. And I think that these kind of meetings are very, very useful, because it's always much better when we are face to face, when we can see each other, when we can talk from the same room. But whatever, I will be back in like 3 days, so we will get back to our standard webinars. But at this time, I'm very happy that I can trade and actually watch the charts with Chris together. Carolyn is saying I would throw a nice party there. Well, probably we'll have some party maybe later on, so we will see. Farhan Ahmed is asking time frame for 5 SMA. Basically, you can apply to every single time frame and to see whichever time frame suits you the most. So it can be applied to, it doesn't matter the time frame. But obviously the time frame is, you will have more movement, but the lag will be also higher, so try to test it on every single time frame. Yes, Ilya, it will be uploaded to Admiral Market YouTube channel. Okay, guys, so we wish you a great evening, and we will be talking to you soon. Cheers, and as always, trade safe.
Cheers, everyone. Have a great evening.